Thank you very much, David, and thanks for inviting me on. I think you've got the buttons to advance the slides there. So the title of this talk is gold. I've got a picture of a rock there, which has a little bit of gold in it. Couldn't start the talk any other way, really. And I'm going to talk to a few fundamentals and things which just sort of hopefully set the scene for you guys to get all hot and frothy about some of the explorers that are coming along afterwards. So take me through the disclaimer, would you please, David? Terrific. I can give you all sorts of ideas and things, folks, but I can't tell you what to invest in. That's pretty much what the disclaimer says there. But if you want to take my advice, you're gonna have to buy some lion. So go and have a look at that. I spent a few hours on the weekend coming up with some charts and concepts that would really talk to this gold thematic. And there's all sorts of conspiracy slippery slides that you can slide down when you want to talk about gold. But having come up with a collection of things, I thought, well, where the hell do I start? That's the biggest problem that I had here was how do you start a talk on gold? And of course, maybe the best place is with a chart. So this is the gold price going back to 1970. And I think one of the things that jumps off the page here, hence the title, up, up and up. Gold's had a couple of really high growth periods in its history post Bretton Woods. So it became unpegged. It could have a life of its own, and it took on a real strong life of its own. Probably where this varies from most commodities is that a lot of commodities reach a price point where the people who are buying it feel pain because they need to purchase the commodity and then use it for something. Gold's value in use is just that it's an investment that protects people and provides liquidity when they can't get it from cash, or when there's difficult or unusual things happening in the world. So gold is absolutely uncapped in terms of the price it can get to. The highest price that people will pay for gold is dictated by investors' imaginations and not what they're able to pay in order to pass it on to someone else. So that's the backdrop. Take me along another one, would you please, David? The other thing which is different about gold is its risk profile. And this is from an investor's perspective, right? Investing in companies which are either producing or hoping to produce gold. There's a whole bunch of commodities you can focus on if you want to be in explorers or if you want to be in miners. And all of those are slightly more difficult. Gold is unusual because as an element, it doesn't complex very well with other elements. So it's reasonably easy to extract. And, you can probably think of some tough gold projects, all of you, but they're still easier than complex base metals or PGEs, rare earths, uranium, you name it. It's easy to get gold out of a rock than just about any other thing. In fact, it's often present in its native form. So it makes it easy to separate in a physical process, let alone having to use chemicals. The second thing about it is that makes it unique is that it's easy to sell. So the extraction risks and the marketing risks that apply to gold are the lowest in the entire commodity space. So this is a chart that we talk to in Lion, and we try to focus very much on the lower risk things, unless there's a very, very, very clear exception. So we're towards the bottom end of that chart. That often drags us towards gold investments. It also means that gold projects are scalable, right? So in a lot of cases, you can start a gold project small and then build it up. I know that's not often how they're invested in, but that flexibility exists because of the unusual nature of gold and how it complexes. Next one, please, David. I use this picture when I've spoken to, you've all got it in your minds, right? That gold nugget that flashed up, and that kind of just makes the point that this is what gold is. I've used that picture when I presented when each of my kids was going through grade 5. Their classes wanted a primer on gold before they started to talk about the Victorian gold rush, which was something that they looked at historically. And you put that picture on the screen and say, does anyone know what that is? And most of the kids in the class say, that's gold, which is a really interesting thing because if you put a picture of copper or iron ore or diamonds or coal or anything else like that, they'd be guessing. It seems with gold that they know. So it's got this ubiquitous mindset for people. Best place to start, though, is if we want to talk about what's going on in gold now and why it's interesting, a bit of history is really important. So what I've got on the screen here is the annual global production of gold going back to 1966, and overlaying on that is the gold price. Now, it's a slightly different chart to what I showed you before because the gold price I've used here is on a log scale, just so that you can see each of its runs compared to each other. So it doesn't sort of diminish the early history of gold by the way that I've presented it. So you can see them each. And you can see there's been 2 enormous bull runs in that time where it's gone up 18 times. In the late 70s and 80s, and then we had a 7 times run. Depending on how you cut this, you might take a slightly larger multiple or a slightly smaller. I haven't taken the absolute intraday tops or the absolute intraday bottoms. I've just sort of cut it to what looks good on a weekly chart. all that I'm presenting this for is that those bull runs have started when gold production started to slide away. Now, that's not to say that that will be the nature of the next bull run in gold whenever that happens, and perhaps we're in it now. But we have seen production fall away. And if over that 50, 60-year time frame, one of the things which has corresponded with gold bull runs starting is that production weakness and things tightening in the market, we've seen that exact same setup happen now. So interesting place to start. One more, please, David. Another couple of interesting events to overlay on the same chart is how producers have behaved as buyers or sellers of gold. And I know that sounds stupid because if you make gold, you should just be selling it. But throughout the 70s and then the 80s, but particularly the 80s when interest rates were becoming high, producers of gold were able to engage in forward sales of gold. Now, people talk about this as a way to protect yourself against being able to put pay back debt, things like that. It's a risk management product. But when used as a financial speculation product, it becomes dangerous. When interest rates are higher, you can sell gold at some point into the future, distant from now, at a higher price than what you can sell it at spot. And that difference is proportional to the current interest rate environment. So through the 80s, you could sell gold at a considerable premium to what the spot gold price was. And that encouraged a lot of these producers to take on fairly large and complicated hedging positions. Now, if you think about it, if the industry is selling gold that it produces, but it's also selling far more gold than it produces because it's selling into these forward sales, it could be depressing the price. And I think that one of the flattest periods that we've seen in the gold market corresponding to this, there is absolutely no mystery in my mind. The flip side of that, when gold price started to move in the late 90s, early noughties, gold moved up a little bit, and a lot of these hedging positions were instantly out of the money. So they became exploding, enlarging financial obligations of these companies. So they had to de-hedge, they had to buy back ounces, and that's what you can see as the next box along. So through the sorry, I had a phone call coming through there. Through the noughties in particular, the producers were buying back enormous hedge positions. They were buying, in some cases, millions of ounces. The industry as a whole had sold forward by the year 2000, I think it was, about equal to a year's production. So they had to buy back the equal of a year's production inside of sort of circa 5 or 6 years as they de-hedged. And when you think about that, there's a big producer buying behavior in the background, which is so substantial, that has an effect on the gold price as well. Let's move on, Dave, please, David. Last couple of just interesting factors, particularly if you're looking at what's happened in global gold production there as time has gone on. There was a peak in South African gold production in 1970. South Africa used to be the biggest producer of gold by miles and miles and miles. That started to decline from 1970 onwards, and as you can see, it had an impact on global gold production then. From 1980 onwards, carbon in leach and carbon in pulp processing proliferated, and what that meant was that you could produce economic quantities of gold from much, much lower head grades because you were able to produce from lower grade ores. And that had an enormous effect on production. It enabled a huge amount of production to come to the market. And that coincided with this period of hedging. So flooding the market with gold from mines, flooding the market with gold from forward sales had an effect on the price. And then, as I said, when it was de-hedging, it gave it a squeeze. Let's move along. Another one, please, David. Just to round off on global production, the biggest producer of gold at the moment is China, followed by Russia, and then Australia. Their 2022 figures, these are sometimes a little bit lagging, but just interesting to note, because as I go on a bit from here and talk about why that's interesting, China and Russia sit there as being slightly different to most of the other gold producers in terms of how they engage with the US dollar global money market, if you like. So I just thought I'd flash that up as a bit of context. Next one, please, David. So this is where the rubber hits the road. Why is gold interesting? And the reason why gold is interesting to investors at the moment in particular is because gold has taken a run in the last 18 months or so. It's gone from a low of about 1640 something to about 2350 something. So it's up 40 odd percent in a period of about 18 months, or let's say since late 2022. Now that's a pretty significant run, and particularly when you think about what's been happening in the micro cap or the risk end of the market, there's been not a lot of love for things. So there's been a real flight to safety. Perhaps gold has benefited from that, but the long-term fundamental for gold is driven by an inverse correlation. So gold has tended to flourish in environments where real interest rates, which is the rate of interest minus the rate of inflation, have been low to negative. And with interest rates going up, that's created this environment for gold, which is not productive. If you had to calculate how that was going to go, you might say it should move sideways or possibly a little bit down, but we've seen a very strong move upwards. So it leads to a question mark. Why is that happening? And I think that's the beginning of the conversation here of why is gold interesting right now. Another one, please, David. I've heard a lot of people say the reason the gold price is going up is because central banks are buying. And to some extent, that's probably correct in that at the moment, central banks are buying, and at the moment, gold is going up. But when you just look at the net purchases of central banks, they've actually been net buyers of gold by a long way since 2009 onwards. So that kind of pattern breaks down. Unless you can extrapolate that a bit, just press the button one more time for me, please, David. So this is where you break out the central banks according to what sovereign nations they represent. You had Western banks being enormous net sellers of gold up until 2009, and then they dropped away. They've been tinkering with the market since. They certainly haven't been the margin pricer of it. And then you've got the BRICS, and this group of BRICS, which it was originally Brazil, Russia, India, and China. It's expanded. It now includes Ethiopia, Iran. I think Saudi Arabia is talking about inclusion. I can't remember if Turkey is in or not, but these nations have been the big purchasers of gold. And I think that's the interesting thing when you look at this chart. There's 4 big spikes in purchases, and these are big purchases which were reported and have probably taken place over months. But as people talk about central bank purchasing, they say India's buying or China's buying. Particularly at the moment, China is buying. And there's this transfer of gold, if you like, from west to east. It's been happening for a while. That's the point that I want to make. So it's a long-term fundamental, but it is getting interesting now. Let's take another step along, please, David. So this is the central bank purchases zoomed in. This is from 2022 until present, their monthly balances. And I've just separated China from the rest of the world. And the interesting thing about China at the moment is its central bank has purchased gold 18 months in a row. Now, if you look back through World Bank data, it actually tells you what all the different central banks have done. It's got it on a monthly basis. China's purchasing of this nature is one of the most aggressive buying streaks that we've seen of a central bank in the data, which goes back to 2002. So that stands out. China's foreign reserve balance, or the proportion of its foreign reserve which it holds in gold, is exceptionally low. I think it's about 6%. Now, that compares to the United States, other developed nations have a higher holding of gold. I think the average even of emerging nations is about 15%. The World Bank put out a handbook, which I don't think central banks really need handbooks, but a handbook which suggests that central banks should be holding circa 22% of their foreign reserves as gold. So China on that margin is a long way behind. I'm not sure if that's particularly pertinent. China has never necessarily followed what Western organizations think they should do, and probably likes to be a little bit different as well. So the reason this stands out to me is not necessarily because of the low proportion of it, although that will probably become significant. For now, they are buying. That's the important thing for me. This is not a fundamental. This is a behavior. We can see it happening. And I suppose the one thing that you would extend from this, and I don't want to go down this conspiracy theory slippery dip, but China, Russia behind them, has also been a significant buyer, and they're both significant producers, right? So I pointed that out a couple of slides ago. Whether that gold that they're producing is going onto their central bank balance sheets or not, it's in the country, and it's part of the sovereign capital base, which is important. 26th of February 2022, the US and the Eurozone imposed sanctions on Russia, which blocked them out of the US dollar system. So it made it very difficult for the Russians to purchase anything with US dollars. It made it very difficult for them to access any foreign accounts that contained US dollars, and it made it illegal for Russian people who were, sanctions against them by the US to use US dollars. So it, creates an interesting dynamic if the US dollar is a global reserve currency. So gold is something which can't be confiscated by the likes of the US. I think they have a very good reason for all this, right? Because of the behavior of Russia in the Ukraine. But at the same time, this is a big sovereign nation turning around and saying you can't use our global currency anymore. So gold takes on an interesting role there. Whether that's what China is caught up in, or whether it's just China saying we want to diversify from the US dollar, they're both pretty good reasons for them to hold the currency. So I point that out at that point. Move along one more, please, David. These slides, or these charts are not, these are to show that it's not just the Chinese central bank which is buying gold, it's Chinese people as well. So this is on the left-hand side, bar and coin purchases. I think it's quarterly data back from 2010. And on the right, it's consumer purchases. So, smaller quantities. And I guess some of you might have seen the articles about Chinese purchases of gold beans, which are a smaller fraction of an ounce. I think it costs about $80 or something like that. Of course, that's going to change as the price goes up, but enables people to purchase gold in small quantities. And I think the really fascinating thing about this is that when the Chinese consumer starts purchasing something, it's an enormous consumer group. It's got huge buying power. And it's a market where their ability to export capital is severely restricted. And they've seen poor returns on things like real estate and their own stock market in the last 12 to 24 months. So, this is a market which could be looking for a way to diversify how it holds its capital base as well. So the proportion of those markets, which is dictated by China, has just moved to the highest point in 14 years. That's got to be significant as well. So Chinese people are buying this gold. One more slide along, please, David. Now, this is the other correlation of gold, which has recently broke down, and it's broken down extremely strongly. Since 2003, when ETFs first became a thing, which enables people to own gold via a securitized product, and they don't have to store it, they just buy it, and they can trade it if they wish. Since 2003, gold has traded in a close correlation with the buying behaviors of ETFs. So if the ETFs are buying, pushes the price up. If the ETFs are selling, pushes the price down. These ETFs, the Western investment market, has become the marginal pricer of gold. 18 months ago, that broke down. It wasn't immediately obvious to start with, but that corresponds with the point where the Chinese central bank started being an aggressive buyer. So as you can see here on the right-hand side of the chart, gold jumps up whilst ETFs have been selling. The Western ETFs have all dropped their tonnage of gold holdings in that 18-month period, whereas the Asian ETFs have built their holdings. So smaller numbers involved with the Asian ETFs, but that is where investment demand is building, and that corresponds with central bank demand and retail demand. One more, please, David. And I mean, part of the reason I think that is enormously significant, right, is that there's one market which is taking a bet on gold. Let's say that's the Chinese market. It's moving it in a direction which the rest of the Western market thinks is wrong. Western markets are selling into that. For that to be the case, you kind of say, well, there's only one market that buys this. It's like a bet one side against the other. And I don't know exactly how you pick teams for that, but it strikes me that there's about 700 million people in the Chinese middle class. If they all decided to buy an ounce of gold this year, I suspect that would probably defeat whatever the objectives are of the Western markets in its behavior towards gold. They might sell into it for some time, but then that brings me to this chart. At some point, gold in its history has started to outperform equities over, say, a 12-month rolling period. And that's the point where Western markets, which is traditionally where a lot of the buying has come from, start to say, are we missing something? And if they get FOMO, as we all know, I mean, whether it's NVIDIA, whether it's Bitcoin, whether it's when something gets ahead of steam, it starts to get buyer interest, and you start to see money rolling out of things like bonds or higher priced equities into other products. And in this case, the speculation is, will that happen with gold? So you've got the gold price there, log scale, the S&P 500, also log scale, back to 1970. One of those has returned 62 times over that period, one of them 60. So they're actually quite close together in the return profile if you exclude earnings. But then when you divide one by the other, the S&P by gold, you can see that there's been periods where one has had the ascendancy. And for gold, that has been periods of time of great uncertainty and high inflation, which has overrun interest rates. So when you run into these environments where interest rates are slow to catch up to inflation, and you decide for yourself what you think is going to happen, gold can get that head of steam. And with a buyer which is ahead of this, which is China, I just wonder about how quickly that could happen. We know that when gold gets ahead of steam, it really takes off. So I think that's interesting. One more, please, David. So you can't talk about the gold price without talking about gold equities. And there's four other fellas on this call who are going to talk about their gold equities. So here's where I segue to them. I've got a 4-year chart. I've got the price of gold, which is in the yellow color. I've got the ASX gold index, and that shows you what the Australian gold producers, if you like, have done in the same period of time. I've rebased all of this to mid-April 2022, and that was the point where the microcap market in Australia started to fall away, which has affected all the explorers. It's also the point where interest rates went from sort of 0.5% to 2%. through 2% and into the 2 to 5% range. So it was the point where interest rates rubber hit the road. And we've seen the explorers fall away in that time, irrespective of what they're focused on. We've seen gold catch a bid, and we've seen gold start to move up, and we've seen that happen quite aggressively recently. We've seen the gold index, the producers, start to move up with it. Although its performance hasn't been as good as gold in the same period of time, it fell away for a period. We've seen the gold explorers continue to fall. So the question is, when are they going to catch a bid? So I suppose at this point, there's a couple of interesting questions to ask, and I don't know what the answers are, but if the Western market is speculating in one way about gold and it's selling into Chinese buying demand, then you sort of have to take the view that a lot of the Western market doesn't believe the story for gold. Yet it's confronted with the gold price is the fundamental, which drives interest in gold equities. So gold equities start to go up. And is that because the buyers of the gold equities believe in the gold equities, but not in the gold price that sits behind it? Perhaps that's a little bit too esoteric. The point I was making on the slide earlier was that when FOMO kicks in, you might start to see either the Western market stop selling or become buyers. And if that's the case, then it's going to firm that up for a lot of things. And I think that's probably the case for gold explorers as well. So if you folks are watching the gold market and you see that ETF volume dropping away and just level off, then I think that's probably the point where the gold explorers really start to shine. And at the moment, we've seen tremendous weakness in a lot of other commodities. So gold stands out there. If there's going to be a dollar going to risk capital for explorers, it's going to find these explorers. They've had a while in the wilderness, and I think they've had a lot of time to think about what their best targets are, which to me makes it a tremendous time to be thinking about how you buy into these. It's no good waiting until the gold market has run and these guys have all doubled in price, because these gold equities, when they're exploring and when they're finding things, can have multiples attached to them, which are huge. You don't want to be sitting there going, this is half over, or it's 90% of the way there. You kind of want to pick some of your bets early. So now is a great time, I think, to be looking for good management teams with really interesting and dynamic projects. And the chart I'm showing here is just that is the point we're at. One more, David, and then I'm going to leave you all with a last thought. So this is just an absolutely selfless plug. Lion Selection Group has invested in 7 new stories in the last 24 months. They've all had an aspect of gold to them. Most of them are gold focused, and there's a couple which are gold and base metals. So, it's not to say we've seen this coming. What we sensed was that the microcap market was falling and that the lowest risk things that we could invest in were going to be gold stories. When we've gone and compared them to everything else, we found that the risk profile in the golds far outweighs what we were seeing in quite a few of the base metals as well. So the best projects we've been able to find have had a gold-rich flavour to them. So there's a few names on this page, but you're about to hear from a few more as well. We've put pegs in the ground all over Australia in order to back these things. In a market where the world is interesting, the world could be a bit dynamic. It's a great place to have your money. So we're very happy to have these projects in Australia, and I think these are probably, in my mind at least, exceptionally strong gold stories to be backing. So that's it from me. Happy to leave that slide up, and David, I'm very happy to answer some questions as well.
Thanks, Hedley. Great presentation, and clearly setting the scene, particularly for what's due to come. We may move on now into our presentations, because I think you have set the scene beautifully. You've whet the appetite. You've let people know that gold exploration companies shouldn't be forgotten for all the reasons you've outlined. And we look forward to following not just Lion Selection and also your views on gold, and see how they progress over the coming months. So, Hedley, thanks for the presentation.
Thanks, David.